Hi, I'm Joel Gillgard with Gillgard Analytics. Thank you for tuning in to this YouTube video clip. The topic is the yield curve spread, and this is between the U.S. 10-year bond, this is government bonds, and the government 3-month T-bill. And so this line chart covers a generation worth of data, and we are going to talk about the topic of today is the negative yield curve that we have. And so just to back up a little bit, how do we calculate this? What is this, right? Well, you take the 10-year bond yield and you subtract out the 3-month T-bill. So normally, right, the normal split here is probably about a little bit more than 100 basis points is what I'm guessing, just looking at this chart. Might be maybe 110 or so. And so basically, just to figure this out, right? So, if you're lending money, right, you will charge more to lend the government money for a longer term before you can get your money back versus shorter term, right? And that is what we normally do. But when the economy is overheating, right, and you have inflation, and the big boogaboo, right, is you have low unemployment, which the lords absolutely despise because they have to pay. It's one of the biggest costs of doing business, right? So you want to keep labor costs low, right? Then you do this by keeping unemployment relatively high. Basically, once normal economy is between 1 and 2, right? So, when it reaches 1, it means that it's just on par, right? And when it goes up to 2 or above, that means that the government is juicing the economy. So here you had a period from 91 to 94 where you had some real government sponsoring, wanting to juice up the economy. Likewise here between 2001 and 2004, and then from 2008 through 2011, right? And you had here another period from 2012 to 2014. Basically, the scenarios, I'm just pulling these. The 10-year bond, say, was yielding 4%, and the 3-month T-bill was yielding 2%. This is very favorable for banks, right? Because they borrow short-term and lend long-term. Now we have, we're going to talk about today's scenario, right? Where we have a negative yield curve spread. And so going back to 1989, 1990, what happens is, this is not always the case, but it's very, very prevalent, is that when the following year, after you've entered a negative yield curve, which was, in 1989, 1990 was pretty severe, you will have the stock market go down. Didn't happen in 96, it came close. It might have been, these are year-end points, right? So this is December 31st or January 1st or January 30th dates, right? Depending on how the holidays transpire. And likewise here, in 2005 so the year end 2005, when the market went into a negative yield curve, at the end of 2006, the stock market was lower. And here is kind of a unique situation because the stock market, we ended 2022 lower, right? So we had a negative yield curve, which started probably, sometime during the summer of 2022 and the S&P 500 ended lower, right? And what has happened is, and this is kind of unique for this generation, is the government has further steepened the yield curve spread, right? So it's gone even deeper. It's even more, it's more than 100 basis points negative. And, my guess is that the S&P 500 will end the year lower than it started towards the end of this year. So you should be getting very, very good buying opportunities come this fall, is my guess, right? And then likewise, when you have these opposite situations like we mentioned earlier, you will have very, very nice buying opportunities. So this is the yield curve spread, right? Again, just to summarize, you take the U.S. 10-year bond yield and subtract out the 3-month bond yield, and that'll give you the yield curve spread. Hope you found this little tutorial on the U.S. Yield curve spread helpful. Please, if you have any questions or comments, please let us know. Thank you.